Good afternoon. My name is Engebakken. I'm an equity analyst working at ABG Sundal Collier. I'm here with Ray Smets, the CEO of Napatech. We're going to do a Q&A session where we're going to ask you some questions. I have a lot of them written down here, which I have been sent in from you guys. So I just want to deep dive into it. FPGA, that's a technology that you're known for, but I don't think that that many viewers sitting home have much insight into it. Can you tell us about FPGA? Why is it important?
Sure, Axel. That's a good leading question. It's a terminology that just rolls off our tongue in the technology world, but I realize to many non-technical investors it's not something that you say every day. But there's a lot of history with an FPGA. And it sits really in a very interesting place amongst all of the different forms of computing that are currently evolving in the industry. An FPGA is basically a field programmable gate array. So what does that mean? What it is, it's basically an array of logical functions that sits on this little chip. It's an integrated circuit. And that we have software that basically combines these functions together to operate at very, very high scale, these massive, difficult computational functions. So the FPGA basically is a programmable device that you can build some very complex software algorithms on top of. It has lots of inputs and outputs and memory, and you can basically build very complex functions on the FPGA. So it's not a new invention, by the way. The FPGA was actually invented by some very bright people back in the mid-'80s, back when I might have programmed on them when I was in college. But they've survived the years of evolution in the industry because what they do well is they provide highly parallelized computing functions. And when you think about the world today, when everybody's deploying cloud and network infrastructure or mission critical applications or cybersecurity applications on servers in data centers, they need to accelerate those applications as fast as possible, provide the best possible service or security that they can provide. And the FPGA basically allows the user to accelerate applications to a much more mission-critical state. So Napatech is a company that's been around since the early 2000s. We were founded in Copenhagen, which is a bit of a center of excellence for FPGA design. And we've spent the entire time building software that runs on top of an FPGA. So we've gotten pretty good at it. It's an interesting concept because the FPGA is not simple to program, but once you build on top of it, it becomes very powerful. So Napatech is a very unique company in the technology industry with a special expertise building software that runs on top of an FPGA, and we're bringing that solution to the market right at the time that it's most needed in the data center and the cloud domain.
Very interesting, very interesting. And I just want to follow up on that because you talk about FPGA and this hardware component, but you also mentioned a couple of times there that you build software running on the FPGA. And how should investors think about you? More like a software company or a hardware company?
It's a good question. I'm glad you asked. I happen to have a little piece of hardware here to show you and kind of demonstrate that topic. So we build these things. They're called NICs, network interface cards, and this is a smart NIC. I'll hold it the proper way with our new branding on it. These are very standard form factor. They fit in servers, standard open servers. So the smart NIC goes into the server. And on the smart NIC, and every type of smart NIC we build, what we have embedded on there, you can't see it because we hide it. We don't really want anybody to yank it off, is the FPGA. And it's a square integrated circuit or chip about yay big, about an inch on both directions, with lots of inputs and outputs. And we designed that onto the hardware board. But this board with an FPGA on it is maybe a very attractive looking board to some people perhaps, not to me. But it will do absolutely nothing without the software. So what really makes Napatech an interesting company is the fact that we've got an expertise not only building the hardware board with the FPGA on it, but the real secret to success for us is how do we build the software to make that FPGA do what it has to do. There's a real opportunity for a company like Napatech to apply itself in certain market domains where that software can be used. One domain, for example, is in the open source domain. We're participating in a conference right now focused on Suricata, which is an IDS-IPS cybersecurity open source app that many enterprise and end user customers are deploying in their data centers today. We can help run that open source application on this FPGA with our software on top of it because we've optimized Suricata to run faster on our FPGAs with our software. So really in the end, the question you ask is Napatech a software company or a hardware company? Well, up to this point, every single unit of software we shipped with the hardware as well. But over time, we're going to see this diverged because our software will run on other people's hardware under certain conditions. So today, we're a software company building a hardware solution to ship our software with. But in the future, you'll see us ship both hardware and software, but also software independently of our own hardware design. I hope that makes sense.
Yeah, sure. I love that you brought the product. So Ray, you've been with Napatech for about a year now, and a lot has happened since you came on board. You have initiated a turnaround, which looks like it is materializing. So I would love to hear your reflections on Napatech after a year as the CEO.
Sure, that's I'd be happy to. I remember first getting the phone call about Napatech February of last year, so it was a little over a year and a half ago. And I hadn't seen Napatech in a while because I had first encountered Napatech back when I was over in McAfee Security when we were looking to solve an application acceleration problem back in 2005. And Napatech happened to be the solution that my team selected to solve the problem. It was a stream-to-disk packet capture solution. But when I had a chance to reevaluate the company a year and a half ago, I noticed that there were some problems to solve. There were some problems with achieving objectives. There was definitely some problems in terms of cash consumption. There was definitely some problems in terms of maybe strategic direction in product areas and investment areas. And so when the board made a decision to hire me to come on board, basically what I inherited was a company that was really in a kind of state of turmoil. But what I assessed as I scratched the surface looking at the opportunity before I joined was that Napatech clearly was a diamond in the rough. Here's a company with a great expertise, with a high barrier to entry, with super brand name customers that any customer, any company this size in the technology world would die to have, with a solution that is fitting into a marketplace that is growing rapidly, but it just wasn't executing very well. So my job as I walked in the door was to quickly assess how the business was going to perform, what were the choices we had to improve the business operation, and my objective and goal, and really my objective to the investors we had at the time and the investors we picked up along the way, was to create a more transparent and predictable business that could generate cash and profit. So a year ago when I joined, I set a kind of a bold objective that by Q3 of 2019, we would be a stable business. We set some objectives and we beat them all. We set some revenue objectives, operating cost objectives, margin objectives, capitalization objectives, and we really worked very hard as an executive team to make sure that we could achieve all of those objectives. And so we've had actually a very good year. So that diamond in the rough, maybe we can make it into a crown jewel one day, because what we have is now a very highly leverageable business with a real purpose in the marketplace, with a technology that really benefits customers. And now we have to find ways to execute revenue growth by using that technology.
Good. Good answer. And I want to follow up on that because you spoke a little about where you have come from 1 year ago and where you are today. And actually you released Q3 results today. And two things I noticed about the Q3 results were a gross margin, which was very, very strong. And you also raised gross margin guidance for the full year. Then the revenue. The revenue growth was very, very strong on a year-over-year basis. But then there also seems to be maybe some seasonality in the business, with the revenue being sequentially from Q2 a little bit down. Can you talk about the drivers behind the Q3 results?
That's a big question on a very big day, because we started this morning with our Q3 results, as you mentioned, and it's been non-stop ever since. But yeah, so Q3 was actually a really interesting report, because it's the fourth quarter in a row where we're actually announcing cash flow positive and meeting or beating objectives to the street. And it's important to us because we're earning our credibility with our investor base right now. We announced, there's a couple different aspects of what you announced. We announced that our gross margins were extraordinarily strong. And we're trying to be very good to our investors, and we're trying to guide the business appropriately. So it was wise for us to raise our objectives on our annual guidance around gross margin. The question you asked is, why was it so good? Well, I was really happy when our CFO woke me up that morning and said, hey, guess what our gross margins were? They were phenomenal. But there's a couple reasons for the reason why our gross margin was so strong, and it's all positive. We had a little benefit from foreign exchange tailwinds. The US dollar was a little bit stronger. We do a lot of business in the US. We benefited from that to some degree. We also had a bit of a product mix opportunity in Q3 where we tended to ship more to end users than OEM customers, and the OEM customers tend to have a lower gross margin. It just kind of all came together beautifully in Q3, and our gross margin was quite strong. But it really points to something, I think, even more indicative of the strength of the business, is that it's also indicative of the fact that the value of our product is high. The customers are buying it, and they're paying a high value for it. The products that we sell are the highest priced NIC cards in the industry. So if we don't sell value, our price will erode. So it's a good sign of non-discounting and high value. It also is a good sign that we're doing a good job managing the bottom line, that our products are designed and built with the lowest cost possible structure, and we're delivering it at a very high value to our customers. So all of those things came together in Q3 with high margin. So we decided to reset the guidance for the year. You asked a question about Q3 revenue, and is there some seasonality associated with it? And it's a good question because we had that question in the Capital Markets Day a little bit earlier. Why wasn't your revenue sequentially higher in Q3 over Q2? Is that okay? Is that the way it should be? And the answer is yes, we guide this way. We are not a recurring revenue business. We're not a software business that just charges a license or a monthly recurring fee or anything like that for. We tend to be a little bit seasonally based. Q3 typically is our most challenging quarter of the year. So if you look into history, Q3 tends to be our lowest quarter in terms of revenue production. And Q4 historically is our best quarter of the year. So we basically have, like many companies, a seasonality structure where kind of Q3 is our lowest quarter, Q4 is our highest quarter, and Q1 and Q2 kind of share the middle two spots. What was good about the report in Q3 was we came out of Q3 with pretty strong revenues for Q3. If you look historically, annually, we looked really good, but historically, we also looked very good. And we feel good about the momentum going into Q4. So we'll see how we can do.
Good. One other thing regarding not only the Q3 but the general development that we've seen over the years is that you have been very cost focused and you have cut costs. I think, if my memory serves me right, it's operating costs are down 19% year to date on a year-over-year basis. And we have seen profitability improve. Do you expect to be in a position where you do not have to ask the capital markets for more money, not to raise more capital?
It's a good question. I'll start with the last part first. I've talked to very wise people that taught me how to raise cash in my career. And you do this all the time in Silicon Valley. So you have to go to the markets and raise cash, whether you're private or public. But usually as a public company, when you raise cash, you really want it to be the last time you raise cash. And I really would like to say that we can achieve that. It's a little early for us to be able to guide that. But it's super important for us to be focused on the fact that we raised significant cash earlier in the year and that every dollar we spend out of the bank better be highly scrutinized. So that takes us to the operating cost side of the question. You're right, 19% operating cost reduction year over year for the first 3 quarters of 2019 is actually quite good. It looks like we took a meat cleaver and we just cut off an arm or a leg. The reality is we took the scalpels out and we had to carve out of the business the cost structure that we didn't think we needed to have. The objective really wasn't to cut cost. The objective was to right size. It's a very different mindset. And I do believe now with the cost structure we currently have in place, even though we're going to continue to focus on what the bottom line looks like and preserve the cash in the bank as much as possible, we've got the right cost structure in place. There's 2 important data points worth mentioning. The first is that for the first time ever in the history of this company as a public company, we were able to report that the first 3 quarters were cash flow positive. I will accept a pat on the back for that, because that was very tough to achieve after last year. But the second thing that's worth noting is that the cash consumption itself is also seasonal. So we do spend a little extra cash, especially as we get later in the year, because the biggest quarters tend to require us to build the most hardware. So we'll see a little bit of cash consumption in Q4, and that's guided and projected. But I think all in all, I think we've done a very good job managing operating costs, and we'll continue to find a way to scrub it. The good news comes next year and beyond, because if we can get to a break-even structure and we can begin to add revenue, you do not have to add as much operating cost as you do revenue. If we double revenue, you do not have to double cost. We have a highly leverageable business model that can spit off a lot of cash and a lot of profit if we hit the markets just right. So we're super motivated to make that happen, and we'll see what we can do.
Excellent, excellent. And I want to pivot a little bit and talk about your go-to-market strategy, because you are a company that has a fairly diverse go-to-market strategy. You sell into OEMs, you sell to end users, you have a new partnership with Intel. Can you tell us a little bit about how you do business and how that go-to-market strategy is developing?
Sure. It's so you kind of covered all the bases, so I'll just kind of paint the picture for you. So a company like ours really tries to go to market 2 different ways. Historically, in the SmartNIC market, you want to be embedded in somebody else's product. And in the past, those products were typically hardware-built solutions by some vendors out there like IBM or Cisco, where our product fit into their product, and then they shipped our product to their end-user customers. That's called an OEM customer relationship, where we don't necessarily see the end-user market, but we work with the maker of the products. We have significant numbers of OEM customers in place, and that's a good thing because it creates a bit of an annuity stream, a little bit more predictable revenue for our business. And we've announced a few of our top OEM customers. I'll just mention a few. IBM and Cisco are 2 of the top 3. We have a very large one above them in the network management space, and we have others in Europe like Corvil and Polystar. Citadel is a financial company down the list in the US. So the crown jewel customer for Napatech is the OEM customer because of the long-term relationship that it creates. But sometimes it's the hardest revenue to get because it takes time to get it. So just as a way to diversify our paths to the market, we also sell directly to the end user that is looking to solve problems in their data center, where they have maybe a rack of servers and they need SmartNICs to accelerate certain applications. And the applications may be enterprise applications, or it could be open source applications, but they have a need to accelerate it, and our SmartNIC is in the right place at the right time. We announced several customer wins just in Q3. Merrill Lynch and Bank of America, for example, purchased our SmartNICs to run applications within their data center. In the past, companies like Facebook have done the same. So we have really 2 ways to get to the market. It's through the OEM relationships, which take time but produce their own benefit to the company, and I call it the crown jewel. But we also go direct, where the transactions tend to be more regular in nature. So you also brought up an important relationship that we announced late last year, and that's Intel. Intel is one of 2 of the largest FPGA makers globally. If you look at the FPGA market, it's a duopoly. You have Intel and you have Xilinx, and the 2 basically fight for share. And we have a relationship with both. So it's really important for us to play in the middle. We're like Switzerland. We want to be okay with everybody. But Intel brought us an opportunity where they build the hardware, but we had the software. And we ported our software over to the Intel PAC card. It's an acceleration card, they call it. And basically, they're going to market to their channel partners to sell more PAC cards, Intel PAC cards. And if the use case is network management related, which is what we bring to the market, then they can buy a software solution from us, and we fulfill it independently to solve that customer's problem. So it's not really an OEM relationship. It's kind of an unusual end-user relationship, but we do it in partnership with Intel, and we're just getting our feet under us in that relationship. So it's an important part of our go-to-market strategy, but it's really one of our newest.
Yeah, cool. And I guess that the distribution of that Intel has is so broad that it gives you a sort of a reach that you couldn't achieve on your own, right?
It's a double-edged sword, Axel. I worked for Cisco, so I know how big companies work, and I've also worked for small companies like Napatech. It's sometimes when you catch the opportunity with a big company like Intel, it takes a lot of time and effort to make it work. And a small company like Napatech sometimes has to go really extra, take the extra effort to make the Intel channel work on its behalf. The one thing I have to say about the Intel relationship is they've done a phenomenal job creating marketing materials that Napatech really could never bring to market quite like Intel can. So Intel brings a level of credibility to the market that just makes us stand up in the market a different way. But it does take time, and it does take effort, and it doesn't happen overnight. But the good news is we feel confident that we're going to see some benefit from the relationship.
Cool. So I want to sort of look a little longer down the road, because you had Capital Markets Day, and those sessions are to look to sort of lift and look down the horizon. And you provided 3-year aspiration targets. Among them, you aspire for 20 to 30% annualized sales growth for the next 3 years. And can you tell us a little bit about how you, what went through your mind? How did you resonate when you made those targets?
It's actually it's a great question, and it's actually, to be perfectly honest with you, not very easy to do. Because a small company like Napatech producing the revenue stream that we have in the current fiscal year, small changes in sales activities with large customers can really move the needle quite significantly. So we had to think about what was the most pragmatic kind of approach to providing a 3-year guidance like that, 3-year aspirations, really aspirations. Guidance is a different story. We'll get to that for next year. But we really looked hard at what we call our 3-prong kind of plan of attack. That our strategy really is to sell our existing product line into the marketplace, and we believe that that product line that we're selling today can produce a certain amount of growth. We're expecting the network management business to produce about 10% growth. And we're investing in 2 new market areas. The next area that we're investing in is really taking what we do best on the FPGA and supercharging it, making it work more effectively in a faster way to approach new opportunities and use cases within the cybersecurity market space. And we know that if we can hit that market with the technology and the resources that we have and the paths to the market that we have, we can see a significantly higher growth rate from cybersecurity. And then we also have placed a bet, and we think it's a very good bet, to help accelerate a part of the whole move of the network transformation from fixed appliances like routers and switches onto the data center or into the cloud. And we've decided that switching, accelerating virtual switching is a good place that our solution can actually add a lot of value. And we believe, starting small over a period of 3 years, that growth rate could be phenomenally larger. We think that's about 80%, the way we currently look at it. So what we did is we peeled the onion back. We said, what do we got now? What will it grow? What are the near-term revenue opportunities in cybersecurity enhancements? What will that do? And what are the opportunities in virtual switching enhancements? And what will that do? And we basically comprise that into a bottoms-up set of aspirations. But from a tops-down perspective, if you look at the market opportunity, the market growth opportunity is significantly higher than 20 to 30%. So we had to spend a fair amount of time in Capital Markets Day today to convince our investors that we weren't sandbagging, that we were trying to be pragmatic and realistic about the potential. We do see the market expanding dramatically in the future, and the use cases that we currently address will also give us growth in the future. We just have to see where that market is developing in order to reassess our aspirations. So 20 to 30% we think is a good number, and we think it's a number that we can hit and beat.
Yeah, good. So you set a realistic target, and you left a little room on the upside if everything goes the way you want it to go. All right, that's cool. So Ray, this has been a lot of fun, but we've actually used up our time.
Oh. Okay.
But I want to give you the chance to give a final key takeaway message to the viewers at home.
Well, I just want to say that Napatech sits in a very interesting spot between two major market forces in the industry. The servers are growing, the applications are getting harder to run, and we sit in a very interesting part of the marketplace. And I would just invite any new investors that are interested in learning more about Napatech to our website at napatech.com, and we'd be happy to get you guys up the learning curve. We think it's a great investment, and we're hoping we'll see some new investors as a result of this.
Excellent. Ray, thank you so much.
Thank you very much.
And thank you.